Hello friends, welcome to my channel again. Today we are going to review NFO. NFO stands for New Fund Offer in the mutual fund industry. So we are going to review the NFO which is coming from the Helios Mutual Fund, and the name of the scheme is Helios Smallcap Fund. Let's get started on that note. Small caps are like spotting a promising street food stall before it becomes a franchise. Early believers take the biggest bite, but the ride is always bumpy. Helios is launching a small cap fund with a distinctive elimination investing style. Let's break it down to see what that means, what are the key NFO dates, what is the team who is going to manage this fund, and whether it deserves a spot in the portfolio or not. Helios Small Cap Fund is an open ended equity scheme. So it is not a closed ended equity scheme, and it is going to invest predominantly in the small cap companies which are aiming for long term capital appreciation but with a very high risk on the riskometer. As it is a NFO, units are offered at rupees 10 during the NFO period. Now, the category benchmark, what it is considering is Nifty Small Cap 250 TRI. TRI stands for Total Return Index. So, the performance will be compared to the broader small cap segment. New funds typically start with a smaller AUM, which makes it easier to enter and exit small, less liquid names quickly. It's almost like maneuvering a bike in traffic versus a bus. Flexibility can help capture small cap opportunities and manage exits more nimbly. Having said that, small AUM cuts both ways. Concentration and liquidity risk are real in small caps. Small caps can swing hard in both the directions. Helios doesn't begin by asking what to buy, it starts with what to avoid. Through a proprietary 8 factor model, it rejects the stocks with red flags, mainly the things like bad themes, weak industry dynamics, governance issues, poor accounting quality, or unjustified valuations. We can think of it like a grocery shopping in which you first toss out the rotten or the overpriced items, and what's left is the not bad basket with a higher chance of quality meals later. This is their approach, which is central to their investing process, and it is called as elimination investing. About who is going to manage the money in this fund. So the chief investment officer and the fund manager is Alok Behel, who has over 32 years of investing experience. He is one of the earliest members of Helios, serving also as the second senior most resource in the Singapore investment team for 18 years, who is also now the chief investment officer in India. The fund will also be co-managed by Prateek Singh, who has over 10 years experience. Earlier, he was an equity research analyst at Helios and Motilal Oswal, and he was covering the capital goods and the consumer durable sector. So, how the portfolio will look like in terms of the asset allocation, 65 to 100% of the money will be invested in small caps, up to 35 in other equities or debt or money markets, up to 10% in REITs. It can also invest up to 20% overseas. It can use equity derivatives up to 50% of the equity component. In terms of real life, if we see, we can imagine it as a cricket team that consists of mostly upcoming players, which are small caps, but with the flexibility to bring in a few senior people or play defensively, let's say debt or cash, when the pitch looks tricky. Let's talk about who should consider it. So, investors with a 5+ year horizon who have a tolerance for very high volatility and a desire to allocate to the small cap growth engine with a disciplined filter can consider it. This is not for short term needs or low risk profiles. If you have been waiting for a process driven small cap fund and like the idea of a smaller, more nimble AUM at launch, this may fit a satellite allocation. Let's talk about the pros and the cons. So, the smaller initial AUM can be more agile in small caps. Structured elimination reduces avoidable errors. Experienced CIO and a research driven culture flexible SIP facilities for rupee cost averaging. If you look at the cons, the small caps carry very high risk. NFOs lack track record. Early AUM concentration can cut both ways in volatile markets. Investor behavior risk if exiting within 3 months can trigger the exit load. So, what is the final verdict on this? For long term investors who are comfortable with a small cap volatility, who value a disciplined, what to avoid process, and want a nimble AUM start, a measured starter allocation during NFO or once it reopens can make sense, ideally via SIP to smooth out the volatility. In case if you prefer the proven track record or have a low risk tolerance, then skip the NFO and watch the post launch portfolio disclosure and the risk metrics before deciding. Either way, align the allocation size with your risk appetite and a 5 to 7 year horizon.